Hello and welcome to our latest Money Show MoneyMasters Podcast segment. I'm Mike Larson, Editor-in-Chief at Money Show, and today I'm pleased to welcome Luke Lloyd, Wealth Advisor and Investment Strategist at Strategic Wealth Partners, to the show. Luke, how are you?
I'm good, Mike. Looking forward to seeing you in Vegas soon. I know we always have, fun in Vegas. So this virtual stuff's cool and all, but looking forward to actually seeing everybody in person and you in person.
Yeah. Hey, I'm with you. In person always wins. Let's talk about the market here, big picture. I mean, where do you think we are kind of in this economic growth, inflation, Fed policy, all these big picture things people are looking at?
That's a loaded question, Mike. I could go so many different directions with that. Let's start with the overall kind of where we're at in this cycle. I talk about it all the time. One of the biggest contributing factors that's keeping this whole economy afloat, everyone kind of knows it, right? But we talk about it a lot, but we don't get into necessarily the specifics of it. This debt cycle we're in. I mean, the government's printing, $1 trillion every 100 days of new debt. That's very concerning, the path we're on there. Corporations are financing old debt with new debt at these higher interest rates. Consumers are using buy now, pay later options to fuel their, spending habits, their addiction to spending habits. I mean, I think there's $700 billion plus of phantom debt out there that's not reported to the credit bureaus. I mean, I think there's like $1.1 trillion of credit card debt out there. There's another $700 billion of buy now, pay later debt. So at the end of the day, all this started, I don't want to go too historical on you, Mike, but 1913, the Federal Reserve was created. When they were created in 1913, there was no cars. Cars didn't exist. People didn't go out to restaurants 4 days a week. They didn't take 10 vacations a year. They didn't work from home. One person went to work. They made that income, came home, bought groceries for the family, ate dinner at home, and then went back to work the next day. That's all there was to do, right? So the Federal Reserve was created during a time, the only time you got interest rates, to use interest rates, was to buy a home, to buy a mortgage, to buy a house, right? And then 1971, we got off the gold standard, which allowed the government to start borrowing money, printing trillions of dollars, flooding the system with tons of liquidity. And that's really what fueled our spending addiction. So right now, the access to credit is really holding up the economy, and it's going to, for the foreseeable future, keep the stock market kind of at all-time highs, most likely, funnel money to the top, the rich get richer, middle class divides. And then in the end, eventually that bubble will burst. The question is when.
Yeah, no, I hear you. I mean, it's amazing. You got those big pictures, the $1 trillion stat about debt. I mean, you look at, for example, more recently, some of these debt auctions, which have kind of bombed, the treasuries trying to sell debt and not really seeing a lot of buy up in the market. And obviously that has implications for interest rates. So, do you think that's going to be a continuing problem as we move into the back half of this year?
Yes. That goes exactly back to my point with interest rates. The economy, Federal Reserve doesn't work the way it was designed. Historically, when you raise interest rates or rates were higher because you couldn't sell bonds to China or Japan because they didn't want to buy them from you, and rates were higher, that would disincentivize spending habits. That would disincentivize consumers from spending money. That would disincentivize corporations from taking on new debt. That would disincentivize governments from spending habits, right? But what we've seen is it's actually the opposite. It has not disincentivized any kind of spending habits. It's just made it more expensive. There's no constraints or barriers for people to stop borrowing money, or the government to stop borrowing money. That's kind of access to credit has changed the game for a long time. So the interest rates remaining high is hitting the consumer hard, but they're still spending money. And that's all investors really need to know. And that's why earnings reports have frankly been pretty good.
Yeah, your good friend Mike Lee, obviously you guys are speaking together at a couple of our events, including Las Vegas. One of the points he had when we talked was about that split, the rich not really having an issue with spending, whereas at the same time, you've got used car loan delinquencies spiking, you got credit card delinquencies spiking, and so on for lower income borrowers and debtors and so on. So how do you see that playing out? Is strength at the top going to be able to hold the economy up, or are we ultimately going to get dragged down by what's happening at the bottom end?
Well, my opinion is until something major breaks, like the job market, all levels of consumers will continue to spend money, whether they're tapped out or not. The stat I always go back to is the $1.1 trillion of credit card debt out there. I think there's $5 trillion of accessible revolving credit. So there's another $4 trillion available of revolving credit. So the question becomes, when does that continue to tick up to that $5 trillion mark? Or when does that $5 trillion mark come down to maybe $2 or $3 trillion because credit card companies and banks are concerned about getting paid back? And the answer to that issue is when people lose their jobs. As long as people have jobs, they can borrow against their incomes, whether it's credit cards, personal loans, things like that, to finance their lifestyle. It's when you lose your job, you don't have an income, the banks stop giving you money and credit card companies stop giving you money.
Sure. Got it. Okay. So let's, we've talked about big picture here so far. Let's talk about kind of where we are in 2024, right? I mean, we're 5 months into the year. We're reaching that midpoint for the year. What do you think is going to happen in the back half of this year? What are some sectors, some things that are good places to put your money given where we are in the cycle?
Well, a lot of that's dictated by the election, Mike. I think me and Mike are talking about that specific topic at the Money Show in Las Vegas, right? November obviously is a big, important time. And I think a lot of the market's going to be eyeing what's going to happen. And let me throw out this stat right here. It's very interesting. The market's a great indicator and predictor of what the outcome of the election is going to be. There's a lot of mixed opinions, whether you're looking at the polls, betting odds, the actual where the money's flowing, or the stock market. And right now, the stock market's dropped, I think, intra-year about 7%. And anytime the stock market drops 7% intra-year, that usually means the incumbent wins. Anytime you have a 17% market correction, that means the incumbent loses. So we haven't seen that so far this year. So something we're paying close attention to is if another correction happens top to bottom of a 17, 18% correction, that means we're pricing in probably a Trump victory. Now, the reason that drops is not necessarily because of the president's policies or what they're going to do. It's because of the uncertainty in the markets, right? So depending on the outcome of the election, you want to look at allocating to new different areas. I mean, if Trump wins, you can allocate to places like oil, coal mines. You can allocate to places like the banking sector, financials, right? Because deregulation is going to incentivize more loans, more spending habits, more growth in the economy, small business. That's going to be pro small business, which is great for the financial sector. If it's more of a Biden victory, you can look at maybe some renewable resources, healthcare. You can look at some other spots, that you want to pay attention to. So I think a lot of it really positioning towards the end of this year is going to be dictated by the election, because at the end of the day, Mike, reality doesn't actually matter of what actually happens in Washington. It's the perception of reality that actually matters. And that's where you got to price and position around.
Yeah, 100%. One of the other things I've seen, you talk about recently in a few of your appearances, is some of these things that are hopefully, at least, if not immune to politics, at least less impacted by that. And that's some of these non-mainstream, under the radar AI plays. I mean, you really like that sector and what's going on in tech, right?
Exactly. Yeah. I'm glad you brought that up. Everyone talks about NVIDIA. We talk about AMD, talk about Microsoft. I mean, it's crowded for a reason. It's because these are the biggest players. They're the arms dealers of AI. That's where all the demand is right now, and they can't even meet the demand with their supply and producing. So we're looking underneath the hood, right? We're looking underneath the radar at a lot of those stocks that are going to benefit from AI implementation as these corporations and small business owners implement artificial intelligence. I mean, the stat I always go back to is 30%. Or AI is going to add 30% to corporate profits over the next decade. If you look at just the S&P 500, $40 trillion plus market cap, that's tens of trillions of dollars of new market cap probably added over the next 10 years. That's going to go to a lot of other places outside of those names. So we're looking at stocks like UiPath as a stock we just picked up. They essentially help coders with the back end and front end develop processes within the business, like Excel sheets, PDFs. You can get rid of employees and essentially automate all these processes within the business to drive more dollars to the bottom line. So UiPath is a stock that a lot of corporations are going to continue to use. We just picked that up. You want to look at other areas as well. Accenture, one of the biggest consulting firms in the world. They're going to help companies start implementing artificial intelligence as every business is looking to, and they just don't really know how to start, right? So you got to think kind of outside the box. That's where we're looking. I think that's where the money's going to be made over the next year.
Okay. I also found the interesting theme you talked about was that people being addicted to lifestyles and what that means for investors. What was your point there? So
we saw it. We've seen it for decades. Really, since the economy has been firing a lot of, on all cylinders, the government started giving out stimulus. Brought up the 1970s, how, that kind of started fueling a lot of these lifestyle addictions. But really, over the past 4 years, even since 2020 COVID, with unemployment benefits, more stimulus in the system, more money flowing into the system, people kind of got addicted to upping their lifestyle. They got addicted to driving a nicer car. They got addicted to going out to eat and experiencing new things. I know the younger generations, let's just use us as an example, the millennials and Gen Zs, they aren't getting married, they aren't having kids. And when you aren't getting married and aren't having kids, that means you're spending money on yourself, which is kind of more of a selfish kind of attitude, but that's a behavior we have to analyze, right? So this addiction to the spending habits, going to Starbucks, getting the coffee, the addiction to sugar. It's not just a black coffee you're ordering, sugary frappuccino at, Starbucks, going there every morning to get a coffee, Dunkin' Donuts, going to Target instead of Walmart even because you want to portray yourself in a certain way and take a picture that you're at Target because it means something more than going to Walmart. Whatever it be, this addiction to lifestyle, people will not pull back unless they absolutely have to. And that goes back to my point. Until the job market cracks, until people lose their jobs, people will do anything and everything to keep spending money and keep their lifestyle.
I'd hate to miss out on a news-based item that came up and not talk about that. I mean, we have this big oil, big M&A trend. Here's another deal. Conoco wants to buy Marathon for $17 billion. Exxon, the other big names have all been active in that patch. What do you think that means for energy, and just what is your outlook on that sector in particular?
Yeah, so I think energy is actually a really good spot, specifically in nuclear. We're not even looking at the oil plays of the world. Democrats, Republicans, not to get too political here, but they both are starting to agree that nuclear energy is one of the cleanest and it is one of the most efficient energies out there. And especially with this artificial intelligence out there, I mean, there's so much energy used with this AI implementation, all these chips that need energy. Because of that, I think nuclear energy is going to be a spot. Cameco Energy is a stock we've owned. Uranium's, the ETF, URA, I believe, is a spot we've allocated money to. I think it's been one of our best performers. Uranium's up 50% the past year. That's where we're looking from an energy side of things. But when it comes to M&A, Mike, real quick, we are looking outside of, just energy for M&A opportunities. We think M&A is going to continue to pick up. The big got bigger, the small got smaller. The bigger is looking to acquire some of the smaller companies because a lot of the big, like Apples of the world, aren't innovating anymore. They need some innovating players. So we're looking at investment banks like even Lazard of the world to help facilitate that M&A transaction. So you can look all kinds of different areas to make money.
Okay. One last question, I guess, since you touched on uranium. I mean, the commodity sector in general, gold, silver, obviously been real hot here. We've had some nice breakouts. Any thoughts on that? I mean, do you think that's going to continue? Is that going to be an issue from an inflation perspective? Just wondering where you're at.
It's less of an inflation, I think, issue. It's more of a geopolitical uncertainty issue and just overall concern in the world. This isn't an economic take. A lot of the things we do in this industry are analyzing, again, human behaviors. It's understanding people, right? Psychology of people. And there's just this innate feeling of people I've been talking to, and even myself sometimes, that there's something around the corner that's not too good, right? There's either a recession coming, or there's the increased geopolitical pressure, whether that's China, Taiwan, or what's happening in the Middle East, Russia, Ukraine. I think gold and silver are going to continue to be a good safety hedge, not necessarily even a hedge against inflation, just a place that people are going to park their money given overall concerns in the world. So we like both gold and silver. We own GLD in our portfolio as a play. So we do continue to like that. I've even been having clients ask me about how to get some physical gold. And I don't think there's anything wrong with having some physical gold as long as you know how, don't know how to not to lose it, right? So I'm not saying go buy a lot of it, but having a little bit on the side doesn't hurt.
Got it. Well, listen, Luke, it's been great speaking with you. I know you're going to be at the MoneyShow Masters Symposium in Las Vegas this August. One of the big things you'll be talking about is what you mentioned earlier, impact of politics on the economy and what it means from an investor perspective. So I think that's going to be extremely valuable. If you're watching this again, that event's going to be August 1st to 3rd at the Paris, Las Vegas. You can find out more by clicking the link in the description below. And if you like this video, you like the things we're doing here, don't forget to like and subscribe, and that way you'll get updates when we have something new. Luke, can't wait to see you in August. Thanks again for your time.
Can't wait, man. It's always fun. Looking forward to it.
Take care.